this business about Goldbach levels.
As requested, in this video, I'm going to provide an overview of Goldbach Mirroring. Now, Goldbach Mirroring is an advanced concept, so bear with me, and I guess you're going to have to see many examples of me doing this until you become comfortable with it, or you can have a look in Hoppy's book. A link to Hoppy's official book is in the description below. Now, before I show you an example of Goldbach Mirroring using the trade that Michael took earlier today, I just want to draw your attention to this post from Hoppy. So, ICT has said many times publicly that he does not trade using Goldbach. Goldbach does not dictate how prices move in the market, and Goldbach isn't a real thing, and it's all made up. So I've seen the stuff that ICT has been posting to his chartered students within his Telegram groups. So for this reason, Hoppy has decided to remove all reference to ICT, to the Goldbach concepts. ICT has claimed that Goldbach has nothing to do with him. So going forward, everything to do with Goldbach is purely originated from Hoppy, and it's his algorithm. And anyone who's making profit out of it, including myself, we have one person to thank, and that is Hoppy. So that's the official update on Goldbach news for today. Now, Michael says he does not trade using Goldbach, despite the dozens of examples I have shown you on my public YouTube. However, what I'm going to do something slightly different today. Michael took a trade, and I'm going to show you how a Goldbach trader would have taken it. So I'll just show you his entries and exits. Okay, so his entry was here, his stop was here, and his target was this buy side liquidity at the top. Now, how can we use Goldbach principles to trade this? Specifically, how would we use Goldbach mirroring? Now, bear with me, this is a super advanced concept. It's the first time a lot of people are seeing this, including in the Discord community, but the information is there. So there's information about Goldbach mirroring in Hoppy's book and also within the Discord, but you may be super new to this, so bear with me. So I'll show you. So this is ICT's trade. This is Michael's trade, but I'm not going to talk about Michael because he says he doesn't trade Goldbach. This is how a Goldbach trader would have taken a very, very similar trade. Okay. Now this is a super scalp, so you've got to be quick on this one, but I'll show you the principles. So Goldbach mirroring is all about how price plays between GB levels, related GB levels, and also the GB levels between different dealing ranges. So let me show you this in effect. So if we change the power of 3, so let's go into super scalp mode so I can show you this play out over a short period of time. So switching to the 9 power of 3. The 9 power of 3 allows us to play between dealing ranges. So the higher the power of 3, the higher time frame the trade is. The lower the power of 3, the more scope there is to see Goldbach mirroring taking place, and especially Goldbach mirroring between related Goldbach partitions. So we're on the 9 power of 3. Let's also reduce it to the 15 second to really show these principles. And like I say, with any of my videos, all I ask you to do is answer the following question for yourself. From how Cam is showing me the price action of the charts, does price action seem to obey Goldbach levels and Goldbach principles? That's the only question I want you to ask. From what Cam is showing me, is price obeying Goldbach levels and Goldbach concepts? So let's have a look. So if we are bullish for the day and we're looking for longs, what we're essentially looking for is a stop run into a GB level. Okay? So let's have a look at the price action. This is the 15 second. Let's zoom in a little bit. Okay. See this fair value gap here? We've created liquidity just where this fair value gap is. Now, not only have we created liquidity at the beginning of this fair value gap, if you have a look at the consequent encroachment levels, This is exactly consequent encroachment. Okay, so let's use the price tool. You see, it's exactly consequent encroachment. That's not the important thing. The important thing is the next step. We are looking for a stop run of liquidity into a GB level exactly. And then we are looking for bullish price action to allow us to get into a trade. So we're looking for a stop run into a GB level and then an entry model that shows confirmation of bullish behavior to get into the trade. So I'll show you this now. Okay, so see this candle here? We have now had a stop run of liquidity to a GB level exactly. Okay, there's your stop run. That's the GB level it was running to inside this fair value gap. Okay, now we are looking for an entry model to get into a bullish trade. Okay, there's your fair value gap. So I would put my trade on like this, and I would have my stop here. Now, this is Goldbach mirroring, which means this fair value gap level and the subsequent fair value gaps will be sensitive. They will allow us to have entries to compound and pyramid our trade and exits to take partials off. So let's mark out all the fair value gaps. Okay, and we just want the fair value gaps. Now observe how sensitive these fair value gaps are. Okay, so I've marked it here and I've marked it here, and the dealing ranges higher up will have these fair value gaps. Do note the mirroring effect here. We had the stop run into consequent encroachment. There's your consequent encroachment here in the fair value gap. So let's get into the trade first. We are tapped into the trade. We can have our stop loss here because we have mirroring going on. Stop run into a fair value gap. So we're now tapped into the trade. Let's observe price action. Okay, can you see how sensitive price was to EQ? Let's take the C's off. Let's take off the consequent encroachments, just so it's easy to see. This is equilibrium. You see? Is what Cam is showing you now evidence that price action is sensitive to the GB levels? That's the question you need to ask yourselves. So let's see what happens at this fair value gap. So let's say we put on 10 contracts. We can take off 2 here. Okay, so we've taken off 2 here. But because the algorithm for mirroring goes between ranges, we can put on more contracts and take some off. Okay. So now we've shifted dealing ranges. So we came out of the old dealing range, and now this is the new dealing range. So this was the high of the previous dealing range. So now we are above the high of the previous. The high of the previous range becomes the low of the next range. And I've marked out the fair value gaps. Because of mirroring, we can come in on this fair value gap if we want to add to our position before coming off at this liquidity level, which is another fair value gap mirroring level. So now we can put our stop to break even. Do you see that? Let's replay that candle. So we could have added to our position there. Let's go back a bit just to show you what happened. We could have added to our position here. So look, we added in this fair value gap, which is respected. We could have taken off here. Once we come back in, we can add some more at this fair value gap, which will be respected. It will not be violated. and then we can take off the rest at the remaining fair value gap. Again, look how sensitive we are to the top of the dealing range. See that? So now we can even move our stop to this old fair value gap level. So this is the target where we terminate the trade. This should hold. This fair value gap level should hold. This is our target for TPing. You could even put some more on here if you want. There you go. The level is not violated because we have mirroring going on. So you could have added here. And this is where we take off our trade. This will not be violated. We can move our stop to here. Creating some liquidity. Respecting EQ. There we go. We've now terminated the trade. So from what I've shown you today, do you think price is obeying Goldbach principles? I know I have never discussed Goldbach mirroring before. There is an old Bitcoin trade on my YouTube though, where I was executing on the 15-second time frame. That is using a version of mirroring. Go check that out. It's a more complicated version of mirroring. But if you want to see a version of mirroring when I was doing a live execution, you can check that out. But replay this video a few times so you understand what I did. And the whole principle was we had a stop run into a GB level. Okay, we had the confluence of this fair value gap, but we had a stop run into a GB level. So all our fair value gaps were going to be used as areas to add to our position or take some profit. Let me show you again. Okay, there's the fair value gap, GB level. That's where we came in. Okay, we could have taken some off here. We could have added to it here. You see, fair value gap is respected. Okay, when we passed above the high, we shifted to the dealing range higher up. We could have taken some off here. We could have added back at this fair value gap, GB level. It will not be violated because we're mirroring. And then we could have taken off the remainder here, which was the liquidity at the fair value gap. I understand this is a very advanced concept, but there's going to be some amazing updates to the book this year. Anyone who has a legit copy of the book gets lifetime free updates of the book. So there's a lot of magical things here that we're going to release. I'm sure we'll expand upon Goldbach mirroring, and there are other cookies that are mind-blowing that will change the game. Okay, if you would like me to do any more videos on Goldbach or have any questions or suggestions, please feel free to leave a comment below. And remember, all I ask of you is to keep your minds open and investigate some of the videos on my channel and make up your own minds on whether you think Goldbach is how the markets are priced.